Hello everyone, my name is Dhruv Sani and today in the course of financial management we are going to cover the long-term and short-term financial options available to a company. So long-term versus short-term financial options that are available to a company. Before diving deep into the concepts, we need to understand the need of long-term versus short-term finance. Firstly, we would take a look at long-term finance and its features. Long-term finance is usually provided to organizations for generating long-term capital assets, right? So financing of fixed assets, long-term finance is need for financing the fixed assets like big machineries which we are going to set up into our business that requires huge finance. So finance is long-term finance is required for the same, providing the fixed part of working capital for the organization, that the capital which is going to remain with the organization, that is for long term. Developing different business ventures, like if we start a new venture, like we know the principal concept of the going entity, business is a going concern. So business is never going to end, like we assume that. So the requirement of funds is for long term. Factors affecting long term finances, like business context, like what kind of business we have, kinds of goods and services we are dealing with, and the level of usage of technology. As the technology requires huge amount of finance and technology is going to remain with the business only, so the long term finance is affected by this determinant or this factor. So the sources where from where a company can raise finance from, basically these are shares, and shares is the form of finance in which organization goes to general public for raising funds. The bait provided here is that the shareholders are considered as an option to gather financial resources. They are provided a share in the stakes of the organization. They are provided ownership in decision making of the organization. There are two kinds of shares, basically equity and preference shareholders, and they are provided timely returns, as well as they have to bear the impact of financial losses of the organization, as they are part of the organization. They are the owners of the organization. Sometimes, as deemed fit, shareholders' timely paid dividend is retained and reinvested for the growth of the organization. Like the profits which the organization gets, sometimes it is retained by the organization only for its growth and development purpose. And debentures is like debt. This is also a kind of financing method where funds are raised from general public. The basic difference between shares and debentures is, this is important part, is the shareholders are provided with ownership of the organization, and debenture holder on the other hand are not provided with the ownership and control of in decision making of the organization. Debentures are basically debt from the public sector and have to be timely repaid, like the interest we pay on loans. Like in the same way we pay interest to debenture holders. The relation between a debtor and the organization is limited to the repayment of loan. Debentures need to be repaid and given higher priority in terms of financial return to the debenture providers, irrespective of the state of the organization, like whether the organization is earning profit or not, whether it is incurring loss. It is the duty or it is the responsibility of the organization to pay the interest or the basic amount to the debenture holders at its maturity. They are provided a fixed rate of return irrespective of profit and the loss of organization. In case of insolvency, priority of returning funds is provided to the debenture holders, but not to shareholders, as they are owners. So the shareholders are responsible for losses as well. Public deposits. This is another source of finance for the organization. Public is requested to deposit the fund for a fixed rate of return. Generally can be called for only by credible organizations. A fixed amount of interest is paid periodically as per the due date. Retained earnings. This is the like when a retained earnings is like when a company earns profit. So it for further need, it basically it creates a reserve, right? It creates reserve. It saves its profit for future. The company retains a part of its profits to be reinvested for business expansion. Term loans from bank. Medium and long term loans for 3 to 5 years can be sought from commercial banks or institution financial organizations. Like this is also a source of finance for the big organizations or small organizations. So the features of shares we are going to talk about. Basically the share is the smallest part of the organization, smallest capital unit, you can say, smallest capital unit of the organization, and has a definite face value. shareholder is provided with the shareholding certificate as the proof of shareholding. Shares come in a numbered form, like when a person buys share, he can buy 100 share at a face value of rupees 100. So he has bought shares of rupees 10,000 and he has bought 100 shares here. Face value of the share held by the shareholder gives an extent of his or her liability on the organization, like the organization is liable to pay him or her the amount of shares he is having. Shares act as a transferable holding units. Shares can be transferred to another person.